Investments involve a trade-off between returns and risk. Higher returns typically come with higher risk, so claims of risk-free high return should be approached with skepticism. Cryptocurrency stories often promise significant wealth but may overlook fraud and regulatory risk. This video is all about risk mitigation. The content is covered in two parts. In the first part, let us explore the types of risk and how to measure it. Welcome to holisticinvestment.in. Risk mitigation is crucial when dealing with high return investments, as the adage goes, higher return, higher risk. While risk cannot be eliminated entirely, understanding the various types of risk associated with the investments and implementing strategies to manage them is essential for successful investment management. First, let us look at the different types of risk. Inflation. Inflation poses a significant risk to investments, often termed as silent underminer, as it diminishes the value of money over time, impacting purchasing power. In order to understand the inflation better, it is crucial to understand the concept of real rate of return. Now consider this scenario. If the return is 6% and the inflation is 7%, then the real return is negative, resulting in a loss of purchasing power. Additionally, taxation further affects actual returns. This highlights the importance of choosing investment options that maintain purchasing power against inflation. Schemes such as Public Provident Fund offer tax advantage and consistent returns exceeding inflation, as they come under EEE category, that is exempt category. Next, market risk. Market risk, also known as systematic risk. This refers to potential of losing money due to overall market movements such as fluctuation in stock or commodity prices. Market risks affect all investments to some degree. However, diversification can mitigate specific risk, that is unsystematic risk, like poor performance in individual investments. Diversifying across asset classes, industries, and regions is key to managing market risk and achieving consistent returns. This table ranks 10 asset class in order of their returns performance from the highest to lowest for each calendar year in the 10-year period from 2013 to 2023. This is evidence that no single asset consistently outperforming others. Next, interest rate risk. Interest rate risk refers to the impact of interest rate changes on the value of fixed income securities like bonds. As interest rate rise, bond prices typically fall, and vice versa, with duration measuring this relationship. Matching your investment horizon with the maturity of bond portfolios helps mitigate this risk. SEBI regulation plays a major role here. This is to ensure proper alignment of your investment horizon and bonds portfolio maturity. This promotes effective management of interest rate risk through appropriate debt fund selection. Next, credit risk. Credit risk refers to the possibility of a borrower being unable to repay the borrowed funds, which is compensated by lenders through interest charges. In the context of bonds, credit rating agencies assess this risk. Government bonds typically carry minimal credit risk compared to corporate bonds. Investors must understand credit risk when considering debt funds, with credit risk funds offering potentially higher returns but also posing underperformance risk. Prioritizing investment safety over potential returns is crucial, particularly for short-term liquidity needs, to avoid the adverse effects of credit risk. Next, liquidity risk. Liquidity risk refers to the challenge of selling an asset quickly without significant loss of value. Real estate is one of the illiquid assets. On the contrary, mutual funds offer a safer option due to their ability to quickly buy back units. Financial assets reduce the liquidity risk compared to real estate, where limited buyers may lead to price declines. Next, reinvestment risk. Reinvestment risk arises when considering selling successful equity funds during market upswings, and finding a safe investment avenue to reinvest the proceeds can be challenging. Next, volatility risk. Volatility risk refers to the unpredictability of price movements. Assets like fixed deposits offering stability, while equity exhibit higher volatility. Here is a comparison of various asset class. Imagine a short-term bond as a calm boat on lake, and longer-term bonds resemble a boat navigating choppier waters, and equity is like a hot air balloon. So, whatever the asset, it is always subjected to volatility. Just that its magnitude varies. Managing volatility involves understanding market fluctuation and selecting appropriate metrics to navigate investment portfolios effectively. Next, risk of fraud. The risk of fraud, as seen in various scams such as the Sarda shit scam, has been a concern for investors. Especially when mutual fund was in nascent stage, investors had many concerns. However, SEBI has implemented measures to counter these risks, ensuring the safety of investors' money in mutual funds. Mutual funds are held in trust under investor's name with stringent safeguards in place to prevent loss even in the face of a market risk or volatility. Thus, the risk of losing the entire invested amount is effectively mitigated. Next, let's see some of the metrics to measure the risk of our investment. Understanding investment risk is crucial as achieving high returns with zero risk is unrealistic. Risk measurement allows investors to assess and manage the potential downside associated with investments, aiding informed decision making for optimal portfolio management. There are many metrics to measure the magnitude of the investment risk. First, standard deviation. It measures how the value of a mutual fund's return fluctuates from its average return. A mutual fund with a low standard deviation suggests more stable and predictable returns. Conversely, a fund with high standard deviation indicates greater volatility in returns. Next, beta. It indicates how a fund's return deviates from its benchmark. A beta of 1 means the fund mirrors the benchmark returns. If the value is less than 1, then it suggests lower volatility, while greater than 1 implies more volatility. Next, Sharpe ratio. It evaluates a return relative to risk. Higher ratios signify better returns for the level of risk taken, indicating adept fund management. Next, Sortino ratio. It focuses on the downside volatility. Higher ratio indicates achieving excess returns with lower downside risk, aligning with the goal of high return with less risk. Next, alpha. It gauges the fund manager's performance over the benchmark. High alpha suggests skillful management providing higher risk-adjusted returns. Incorporating risk metrics such as standard deviation, beta, Sharpe ratio, Sortino ratio, and alpha provides investors with a comprehensive understanding of risk-adjusted returns. While these metrics offer valuable insights, it is essential to consider them in conjunction with the other factors for informed investment decisions, ensuring alignment with investment goals and risk tolerance levels. Now it's time to look at two important misconceived risks: tracking error and expense ratio. Tracking error. Active funds often outperform the index funds due to the generation of alpha, which is absent in index funds. Factors like tracking error and expense ratio contribute to the underperformance of index funds compared to their benchmark. Active funds have the advantage of avoiding certain risky assets during market turbulence, unlike index funds, which must mirror the index composition, potentially leading to slower recovery. Next, expense ratio. While some investors place significant emphasis on the expense ratio, it may not always be the sole determinant of fund performance. Mutual fund returns are calculated post expenses, meaning comparing returns directly can provide a clear picture. Choosing a fund based solely on a lower expense ratio may overlook higher potential returns. Ultimately, a good fund may generate high returns while maintaining reasonable expenses. Next, how to utilize these metrics. Now, let us apply these metrics practically. Begin by identifying the investment categories you are considering. Then, narrow down the selection to specific funds within each category, such as large cap or mid cap. Within the selected funds, examine those with the following characters, comparing them against each other and selecting the most suitable. Low standard deviation, high alpha, low beta, high Sharpe ratio, and high Sortino ratio. It is as straightforward as that. The first part ends here. We will be covering other aspects of risk like riskometer in the second part. Detailed blog post on this topic is available in our website and the link is given in the description.
Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.